Have you ever wondered what central banks actually do? Could we live without them? Today, almost every country in the world has a central bank, the institution with the greatest impact on national economies. Yet most of us know very little about them. In reality, they know a lot about us, and the decisions they make shape our entire future. How? Let's find out. First, let's quickly look at how central banks emerged. In the 17th century Europe, many different banks issued their own money, creating major chaos in trade. Governments realized they needed a single stable currency. In 1609, the Bank of Amsterdam was established for this purpose, but it shut down in 1819 due to war expenses and bankruptcies. However, Sweden's Sveriges Riksbank, founded in 1668, is still operating today, the world's oldest central bank. In 1694, the Bank of England was founded to lend money to the state. This model inspired other countries to establish similar institutions, allowing governments to finance wars and infrastructure projects. By the 19th century, many countries had their own central banks. For example, the Bulgarian National Bank was established in 1879, and the U.S. Federal Reserve in 1913. So how do central banks manage the economy, and what exactly do they do? Their first and most important duty is to conduct monetary policy. To control inflation, they adjust money supply and credit conditions, usually through interest rates. When inflation rises, they raise rates to slow spending. When inflation falls, they cut rates to stimulate the economy. Imagine prices rising rapidly. Bread jumps from $10 to $15 in a short time. People, expecting even higher prices tomorrow, rush to spend immediately, pushing prices up further. If the central bank raises rates, credit cards and consumer loans become more expensive. People borrow and spend less, reducing demand. On the other hand, if prices are stagnant and businesses can't sell, the central bank lowers rates. Loans become cheaper, people buy houses, cars, or appliances, and the economy revives. The ultimate goal is to maintain price stability by preventing both runaway inflation and dangerous deflation. The second duty is issuing money and managing the national currency. In the past, many banks could print their own money. Today, only the central bank holds this monopoly. It issues banknotes and coins and safeguards the value of the currency. Since most countries now operate on fiat money rather than gold, trust in money relies entirely on the central bank's policies. The third duty is particularly interesting, being the lender of last resort. Private banks may also face urgent liquidity needs. If a financial crisis erupts and depositors rush to withdraw their money, the central bank steps in. By providing temporary loans, it prevents banks from collapsing and the system from breaking down. In this role, the central bank acts like the insurance policy of the financial system. The fourth duty is supervision. Many central banks regulate and oversee commercial banks and financial institutions. They ensure banks hold sufficient capital, avoid excessive risk-taking, and protect depositors. This oversight is vital for trust and stability in the financial sector. The fifth duty is serving as the government's banker. The central bank manages the state's accounts, makes public payments, and, when necessary, oversees government bond issuance. It also holds the country's foreign exchange and gold reserves and may intervene in currency markets when needed. Through these 5 core functions, central banks smooth out economic fluctuations, preserve the value of money, and keep the financial system running. In short, the central bank is like the conductor of the economy's orchestra, setting the tempo with monetary tools and restoring order in times of crisis. But are all central banks the same? Of course not. There are several different models worldwide. The most common are independent national central banks. These operate free from political pressure, focusing primarily on price stability, meaning low inflation. The European Central Bank, the Bank of England, and the Bank of Japan are examples of this model. The second model is the currency board system. Here, the local currency is pegged to a strong foreign currency, such as the US dollar or the euro. Every unit of local money issued is backed by an equal amount of foreign currency in reserve. In Hong Kong, for example, the Hong Kong dollar is pegged to the US dollar. The third model is a shared central bank. The clearest example is the Eurozone, where 19 countries use the euro under the European Central Bank. In this case, national governments completely surrender their independent monetary policy. Finally, there are countries without a central bank at all. This is called dollarization. Some small countries adopt foreign currencies directly, such as the US dollar or the euro. Andorra and Monaco use the euro but have no say in the European Central Bank. In fact, they don't even have their own central banks. These countries gain strong currency stability but lose monetary independence. In conclusion, whether we like it or not, central banks are indispensable. Having a well-run, independent central bank is a huge advantage. It keeps the economy stable, prices under control, and minimizes the damage of crises. Without one, hyperinflation, unemployment, and poverty inevitably follow, as many countries have painfully experienced.